Okay, so good morning, folks, and great to have you all here with us this morning. And my name is Pat Downs, and I'm with the Institute of Management Consultants. So, as the winter approaches and the autumn evenings draw in, I think today actually is the first day when the darkness is longer than the lightness until I think next March, St. Patrick's Day, as it happens. I think is when the curtain lifts again. So, on this auspicious day, we're bringing a little light into the subject matter of ESG, and our colleague Meghan from Diligent is with us, who will shine a bright light in this area that's very exciting at the moment and a really growth area in terms of the whole consulting space. So what I suppose like to kind of go through with you a little bit is walk you through the Institute and what we're about, and then introduce Meghan, and after that I'll let Meghan share her thoughts. So as I say, what I would ask you to note is that we're recording this, and we will be disseminating the recording after the event. And equally, if anyone has an issue with that from a GDPR point of view, I would ask you to step off deck now, close the door behind you gently, and we'll send the recording out to you afterwards. Other than that, just to be advised, we are recording. So the Institute of Management Consultants and Advisors is the preeminent organization for professional consultants here in Ireland, and we're part of a global community of 56 other institutes across the globe, including the continental United States, where it's quite large, in the US and in Canada, right into the subcontinent, where we have people joining us this morning, and equally across the European theatre, and particularly in our colleagues in the UK. We, at any given time, have a broad spread of members across three different categories, I suppose, if we would call it that. The major category would be in the professional consulting houses, the likes of EY or PwC and so forth and so on. The second category would be the smaller, I suppose, uber niche consultants who specialize in particularly focused areas. And then the third category we would have is either individual, but we'd also have student members. So we have quite a large and growing student cohort of about 700 members. We have 29 accredited master's level courses throughout the state, and that's growing, and that's a really big population. So part of our ethos, and indeed that's been driven by our current president, is that whole area of knowledge sharing and encouraging people to bring up their skill sets and be more professional within the engagement to have with clients. And we do that through, I suppose, professional accreditation, CPD courses like this morning, and general approbation within the industry, and being a stakeholder engagement with government, for example, and so on. So having said all that, I know it's not me you're here to see, and we're quite excited this morning to bring Meghan Day on board. Meghan is a senior vice president with Diligent, and she has a storied background across the whole IT space, and indeed has stood proudly with her colleagues in Penn State, representing them and the alumni boards and so on. And she has a very potent CV, which you can appraise yourself across LinkedIn. I would not be able to do it justice, or nor do we have the time this morning to go through the lengthy accreditations that she has. But suffice to say, she is at black belt level in this particular area, and we're delighted to have her here with us this morning. I was speaking with Meghan earlier, and she has good Irish kind of roots across the day and early background, both Roscommon and I'm guessing kind of West Clare into Inishbofin, where there's a lot of days still populating the space. And she get a big Céad Míle Fáilte the next time she comes to Ireland to visit Diligent's new HQ in Galway, as it happens. So, and I was delighted to hear that she is also a black belt now in making brown bread, which she has mastered over the period of COVID, as we all did coming out of that terrible space. So her time wasn't wasted within that context. But look, I guess what we want to talk to you about this morning, and maybe share some knowledge, is really surfing the zeitgeist with ESG, environmental, social, and governance. And we partnered with our colleagues in the Corporate Governance Association of Ireland, who became our partners and were subsumed into the Institute here over the last couple of years. And as part of that topography and a changing landscape, we see a huge evolution in consultancy practices enveloping the whole ESG space as a huge area of growth. And it's really timely, particularly with the SDGs and what went on yesterday and over the last kind of year as well, and Glasgow just coming out of it, which seems to be a while back, but it's not that long ago in real terms. And, no one gets out of bed trying to do a bad day work for the environment, but we all try to make best endeavor. And I suppose if I was to look at ESG, it's really about doing things better for the greater good, corporately speaking, if we have to encapsulate it. I mean, it really comes out of the whole CSR agenda, corporate social responsibility, which had been developing kind of into a mega trend over the last couple of years, where people were beginning to capture that in their annual reports, for example, and you would see that kind of cascading through the PLCs and so on, where now it's becoming more formalized and people are actually, there's KPIs and measurement metrics coming in, and it's a huge area, and government are actually getting behind it. So you will see over the next 5 to 10 years, metrics coming in that are required in terms of performance criteria. And we're seeing regulations coming out of Europe in the next 12 to 24 months that will be laying in for corporates certain levels of requirements in terms of the reporting structures and so on. And you're already seeing it in some of the social ends of it, but probably on the climate end of it, it'll become more granular. So that's a very quick snapshot, Meghan, I guess, if I can say that. And I don't want to steal your thunder in any way, but we're delighted, as I say, to have this chat with you and seek your guidance and your knowledge in terms of where we're at. And if you have any questions, folks, if you just put them into the chat box and we'll harvest them during the course of it, and we'll get to Meghan, we'll have a little Q&A afterwards. And as I say, we are recording it. And if indeed any of you have a burning desire to ask any questions thereafter, please drop us an email and we'll be delighted to engage with you. So Meghan, without any further ado, it's over to you. Let's rock and roll.
Perfect. Thank you so much. And I'm really delighted to be here. I think we'll have a great conversation. I just really want to set the stage, because when we talk about ESG, I think everyone in this Zoom room probably has a different perception or thought about what ESG really means to them. And three very simple words are starting to introduce a lot of complexity into our worlds. So I wanted to start with a quick primer, and then I'll spend some time just sort of looking high level at the landscape right now, some of the trends that are happening, both in Europe, but also some data that we have related to Ireland, and then free to answer any and all questions about what's top of mind for you. So primer on ESG, the term relatively new, although things like corporate social responsibility have been around for a long time. But I think that the backstory is important, because it really got started in the financial services space alongside the United Nations, who has, like the SDGs, have been very active in trying to, for lack of a better term, save the planet and lead a lot of environmental initiatives that will help us do that. So ESG, the term, was coined in 2004 as part of a report called Who Cares Wins. It was a result of a joint initiative between the United Nations and about 20 or so different financial institutions from, I want to say, like 9 different countries. It was all about developing guidelines, recommendations on how to better integrate a couple of things. So environment, social responsibility, and corporate governance issues, and taking that into asset management, securities brokerages, research functions that go along with that. I have seen it likened to a corporate social credit score, if you will. So I think that context is important, because when you think about what ESG means now, it's taken a much broader scope. And so to look at the history, I think, is important. So those that were involved way back in 2004 in supporting the report and creating it, they were convinced that a more globalized, interconnected, competitive world, ESG issues are going to be part of, sort of overall management quality to compete successfully in this world that was being disrupted by a lot of different factors. And I think that's still very true today. And this presumption that companies perform better with regards to these issues and can increase shareholder value. If they can manage these risks, they can anticipate regulatory action, they can assess new markets, and then at the same time sort of contribute to the sustainable development of the world around them. So it goes sort of hand in hand with the work that the UN was doing at the time, and really equipping investors with how they could incorporate these factors into their research that supported investment decisions. And I think, I say all of that because, and I've mentioned this, that um, it's become very complex right now. And I think at its core, ESG is really best characterized as a framework that really helps stakeholders now, maybe not just investors, understand how an organization is managing risks and opportunity related to those non-financial criteria around environmental, social, and governance. And while it got its start, I think, in the world of investing, and it's certainly changed, and we'll talk a little bit about this, sort of the investment and capital allocation decisions of investors around the world. You know, this idea of who those stakeholders are originally back from 2004 has really quickly evolved over the last couple of years. And it's not just the investment community anymore. It's customers, it's suppliers, it's employees, it's the community around there. So for me, uh, that concept makes a lot of sense. That framework makes a lot of sense. So how did we end up here? A couple of months ago, everyone's favorite Twitter troll, if you will, Elon Musk, ESG is a scam. It has been weaponized by phony social justice warriors. I mean, that's a bold statement from a man who likes to make bold statements. And, I'm sure there was a lot of, well, there's probably not a lot of thought that went into this tweet, but certainly a lot of intent to get people up in arms over it. And that it certainly did. But is ESG just a scam? Is it a glorified marketing exercise? Is it just virtue signaling by everybody involved? It's certainly a big money maker on the investor side. This idea of ESG investing, it was something small in 2004, but it is a multi-trillion-dollar pot now for those players. It's something like 50 trillion dollars in assets as of late. That's a huge chunk of change. And forgive me, I have not been following Irish politics closely, but here in the United States, ESG has become wildly politicized. Members of the conservative Republican Party here in the United States are coming after the likes of BlackRock, the largest institutional investor in the world, and saying that ESG capitalism or ESG is a scam. Like Elon Musk said, that it's this idea of like woke capitalism, if you will. But I think one, Elon's trying to get a rise, and certainly it could be the same goes for some of the politicians here in the United States, the desire to make headlines. But around the world, there's this significant rise in the idea, the adoption of stakeholder capitalism, the idea that people and planet and profits, they're intertwined, and that corporations really do play a massive role in the success or failure of the world around us. And I think that's increasingly becoming the sentiment of the largest companies in the world, many progressive leaders around the world. And I think, an example here is from Paul Pullman, who ran Unilever for a very long time. And he has been a very outspoken leader when it comes to adopting ESG and making sure that companies really demonstrate that they are making the world a better place for us all, to be responsible social corporations really at their core. And the question right now is, this aspiration is coming from companies, they're being pushed from communities, from their employees, from other stakeholders. How does that play into financial success? And can those two things be married together and not muddied in such a way that we see it right now? And in my mind, a huge problem with maybe the disconnect between the Elons and the Pauls of the world is that perhaps, this very short acronym, encompasses too many things. I just put up on screen here, what the categories or maybe some of the supporting related metrics for ESG are. And, you look at this, one, there's a million things on here, and every person, organization thinks about this a little bit differently, and rightfully so. There's also no weighting across this. Is your carbon footprint more or less important as a company than the safety of your employees? I mean, who's to say that? How are you being judged? Um, and the ESG ecosystem surrounding all of this is really not making anything easier. Everything really remains poorly defined, not very well regulated. So everyone is confused. Investors, companies. You talk to, certainly. When I talk to my family members about what I do, what they know about ESG are those headlines like um, Elon Musk saying that ESG is a scam. So my mom's concerned about my job security, as I have ESG in my job title. Um, but it is all to say that confusion, I think, is really putting a little bit of doubt into people's minds. But how much doubt is that around the concept that we're trying to solve for, which is to make the world a better place, um, versus all of these things sort of spiraling around it? And is that distracting from what we're trying to do? Is it stalling, deferring necessary conversations about how we actually support society and a planet that succeeds, not fails, as Paul said? And we've managed to make it very complex in this sort of ecosystem that supports this idea of ESG. So I think a little bit of context here in terms of the players, sort of outside of the investors and then the companies themselves. Those are obviously sort of who this world revolves around. But as a result of all of these other things supporting the idea of ESG, it has become a little bit unwieldy. So there are the framework providers. They're really not in this to make money. They are, I think, at their core, you could say they're in this to change the world. They want to improve the ways that companies measure and demonstrate those contributions towards creating a more prosperous, fulfilled society, a more sustainable relationship with our planet. That sort of gets back to some of the mission of obviously the UN and the work that they were doing with financial institutions 20 years ago. But it has, we sort of lost the plot a little bit, but investors care about this because this was a great mechanism for them, and the way that it was set up in 2004 was to get sort of some more or less consistent data from companies on what they should be paying attention to related to these risks. And so you have the SDGs from the UN. You have things like the World Economic Forum, huge global think tank that's putting out recommendations on what to pay attention to, SASB, ISO, all of these organizations that say, here is what you need to be thinking about. We're not going to tell you if you're doing it well or poorly, but here's a framework to operate under. But then it starts to get increasingly complex because how do investors then take that information and make more informed decisions on the investment side? So there's an emerging world of ESG rankings and disclosure organizations, which ask companies to provide certain information, complete questionnaires, surveys, and then have your what you submit compared against your peers, others that also submitted this information. A lot of these, I think, maybe have more niche perspectives on what they deem to be important. For example, Just Capital, NGO based here in the United States, they have rankings. They have laid out their own criteria on what they think is important to be a just company. They ask organizations that would like to be considered for this to submit to them. Same with CDP, global organization focused on environmental sustainability. I cannot for the life of me remember what CDP stands for right now, but a similar thing. They have a framework and a questionnaire that they ask companies to submit, and again, helps provide some standardized data to help investors think about how you compare vis-a-vis your peers in some of these key areas. And what's really, I think, in a lot of ways thrown a wrench in this and pissed people off, for lack of a better term, is the ESG ratings companies. In my mind, I think in a lot of ways are really just in it to make money off of investors who are really hungry for more data. Investors are used to very, very sophisticated financial modeling when it comes to making their investment decisions. They have, leaps and bounds, decades, centuries worth of data that they can use to make their decisions when it comes to looking at financial performance of companies, but they don't necessarily have that on the ESG side of things. And so, whether you think it's a money grab or not, their outputs, the rating agencies, it's getting a lot of attention. But I just don't think it necessarily reflects how good a company is for the world at large. And that was sort of, again, going back to 2004, like what was the purpose of all of this? And there's lots of inconsistencies in terms of rating companies. Basically, most are taking publicly available information, scraping your sustainability report, your website, press releases, and saying, all right, XYZ company, you know what, you've checked 10 boxes, you get this score. This company checked 15 boxes, they get that score. And it's not necessarily comparative to anything else in the ratings world. One other note here, and I think hopefully this is potentially all coming to a close, or hopefully some more clarity. There's a lot of buzz lately about, like, should we just get rid of the term ESG? I kind of fall in the camp where I'm not opposed to that idea. I think it confuses everybody, or we make it more solidly an investment term versus companies maybe how they think about adopting stakeholder capitalism and representing that inside of their organization. Because it is not, from a company, when I think about how I adopt these principles, how I think about how I operationalize them inside of my organization, it's not like I'm going through that first slide that I showed that said, here's what E is, here's what S is, here's what G is. It's not meant to be, I'm going to go down this list and check all of these boxes and make sure I'm doing all of these things against this. It's meant to be a much more sort of fluid framework for you to say, all right, here's what matters most to my organization. Here's how I'm thinking about some of these issues. And I think people have just sort of jumped to try and make sure that they are embracing this and adopting this as broadly as possible. And as a result, maybe not necessarily seeing the results or the impact that I think was really the intent of this concept of ESG 20 years ago. But as I mentioned, I do think the days of the wild, wild west are coming to a close. And I think that's due to a surge in ESG disclosure regulations. This idea of, like, let's, make sure that everyone is measuring and monitoring the same thing, taking this idea of what gets measured gets managed approach. And I think that will be so important moving forward. This idea that regular, consistent reporting on a company's environmental and social impact will help investors, consumers, policymakers, runs the gamut, help them evaluate their non-financial performance, and then I think in turn, because this is all sort of a collective give-get ecosystem, encourage companies to develop more responsible, sustainable approaches to business. And I think what's really going to change this is CSRD, which is Corporate Sustainability Reporting Directive, European-based, likely to be finalized in the next couple of months. And it will have, I think, massive implications for companies around the world. I have been paying attention to it as someone in this space, but I did a webinar earlier this week with big law firm Kirkland and Ellis, one of their ESG partners. And the woman leading the session said that she likens CSDR to be as big or possibly bigger in terms of impact, work required, as GDPR was a couple of years ago. So something that's going to have broad reaching effects inside of organizations, in a lot of ways change how companies work. And that to me is sort of eye-opening. You know, I have been, as I mentioned, paying attention to this, thinking of it more as you know, something that my poor colleagues in Europe would have to worry about, but it's really going to, I think, change the game when it comes to setting some accountability here and really pushing companies to be transparent about how they're going to be a more sustainable business. So if you're not familiar with CSRD, I'll give a very quick overview. If you're interested in learning more, I'm happy to point to more resources, including this webinar that we just did with Kirkland and Ellis. It was great. So CSDR, it expands on the EU non-financial reporting directive, which has been out for a bit. Expands on it in a couple of different ways. I think most notably the number of companies impacted. So there's about 12,000 companies under NFRD. That's number, it's going to be close to 50,000 when it comes to CSRD. So it touches many organizations, not just in Europe, but also if you are a global organization and have operations in Europe, if you meet a certain threshold, you're going to have to apply to these regulations. So again, when you think about that comparison to GDPR, the reach is really incredible. The scope of what's being reported is also expanding, particularly around this idea of double materiality. So what's the sustainability risk, you know, including climate change, things like that affecting the company? That's obviously something that investors have cared about a lot for a long time, you know, back to that 2004 conversation. But they also want to see what is the company's impact on society and the environment. And this is really one of the first times that it's tying both of those pieces together for organizations. So that's huge. And then the third, and this is very much, I think, still evolving and will probably start out on the lighter side, but the third is really around third-party assurance requirements. So working with a third-party auditor, much like you do your financial statements, to make sure that what you're saying is accurate, and that the impact that you're claiming is real. So that really starts off for the big organizations who have been actually, you know, getting auditing on their sustainability reports and that data for a couple of years. If you look at like the Unilevers of the world or the Walmarts of the world, but as this continues to have broad-reaching impact, you know, I think this idea of getting you know, your data audited when it comes to this, you know, really all of these broad-reaching non-financial pieces that go into ESG, I think will be important to pay attention to. So to wrap things up here, I just wanted to share about what we're seeing for companies here in Ireland. So our Diligent Institute, that is our research and think tank arm of the company, conducted a survey last November with the Institute of Directors in Ireland. And I think it gives a good pulse of what's top of mind regarding ESG in the country. And I'm actually happy to share that we are fielding this survey with IOD. It's about to go into the market in a couple of weeks here. And so I think it'll be very interesting to see how sentiment has changed amongst leaders year over year. A lot has happened, I feel like, since last November. Did my screen just turn green, or can you guys see that?
It did, Megan. I thought that was a note towards your Irish background that you had delivered.
It must be.
We were all awake. It's fine. Yeah, we like green in Ireland. That's okay.
Is my computer dead? I'm wondering. That would be.
Not to worry.
Well, so you won't see the wonderful statistics here. Let me stop my share and started again. Maybe that will help. Does that do
Ah,
something?
yes, we're back
The
again.
good turn it on, turn it off again. That always helps. So back to this survey here that we did with IOD, we're doing it again for a second time. Wanted to also say that Pat, you were mentioning before, we have Diligent has a great presence in Galway. If anyone here is located in Galway, we are going to be doing an event with IOD at the end of November, early December, when the findings of this report come out. And there goes my screen again. It's telling me, Megan, you're up way too early. So let me stop that.
Well, I saw that report when it came out. It was quite interesting, actually, and it'll be timely to reharvest the information. You talk to CSDR, which really is coming front and center now, Meghan, here in the European theatre. And I think it's a good analogy to look at GDPR as I suppose the way we're going to be looking at that as well, in the context of the scale of impact, because where it's differentiating from the previous non-disclosure reporting element of it, non-financial. There's so many TLAs on that. It's the scope and scale, and the fact that you're going from about maybe 12,000 to 50,000. So anyone with over 250 employees is going to be captured in that. And there's also kind of all government entities. So where people, the sting in the tail, particularly for a lot of our international colleagues, is in the supply chain. So, for example, if all European countries now are bringing their stuff in from China, as a case in point, from a manufacturing base, or Southeast Asia, or indeed South America, or so on, and similarly for operations that have footprint, as a classic example, Diligent do, although it wouldn't be high in the manufacturing of physical products, but it is in digital products, for example. So the supply chain issue of that is going to have a huge impact. And there's, every cloud has a silver lining. So there's a huge cottage industry developing at a rate of knots in terms of compliance and fulfillment. And I can see our colleagues in the audit houses licking their chops, getting ready for another 2 pages at the end of the annual audit report in this stage. So it's at least someone will harvest some goodwill from this additional compliance. So what I would say to you is, I know you have a few more slides. I don't know if you can get them back up again on that.
It seems to crash. I'm happy to just share 30-second summary of what we found last year, and then of course happy to take questions. I think high-level takeaways from this survey. So over 80% of respondents said ESG issues, however you define that, are discussed at the board level at least annually. But what I think is really interesting is that that number was closer to 50% pre-March 2020, aka the start of the pandemic. And I think that we haven't talked about that, but that's really, I think, been such an accelerator when it comes to I think really companies getting on board with how important these types of non-financial metrics are and impact in the world around them. I think it just showed obviously how interconnected we all are and how important it is for the safety and security of employees and the community around us. So from 50% to about 80%, we're also seeing frequency climb quite a bit. So about 30% said that they expect ESG will be discussed at every board meeting, and 97%, which is just about everyone, said that it will be a boardroom conversation at least once a year. We also asked about messaging and goals from a company perspective and how that aligns to long-term strategy. Sort of fit a little bit in the middle, scale of 1 to 10. So about 6 out of 10 said that or feel that their ESG messaging is aligned with the company's vision and long-term strategy. So a little bit of room for improvement there. And then I think another interesting area, and we could probably have a whole separate conversation about tying ESG metrics to executive compensation and remuneration. That is definitely still an emerging area in Ireland. About 17% said that their companies are tying ESG metrics to executive compensation. That's a bit lower than across Europe as a whole, which is in the low 30s. 30%, but really not that dissimilar from what we're seeing in the United States or some of the other larger markets. Big companies in the United States, like the S&P 500, for example, about 60% are using ESG metrics in their compensation plans. But when you look at smaller companies, even smaller public companies in the United States, like the Russell 3000 index, for example, it's about 10%. So Ireland's in some ways faring a bit better than some of the companies here in the US. And that's really, I think, going to be, as I mentioned, an evolving area and probably a great point of conversation or a future webinar to look at how companies are doing this. Because if we're struggling to define ESG, which I think we still are, how does that apply to how your executives are getting paid, and how do you figure out what makes the most sense for your organization? And then I think the only other real thing is really the difference between public and private companies.
Yeah.
And we see that globally too. So, public companies, particularly larger public companies, tend to be, out in the lead here globally. But private companies, particularly when it comes to thinking about how this integrates with the board and long-term strategy, definitely faring a little bit lower than their larger counterparts in Ireland, but also around the world.
No, that's really interesting, Meghan. I mean, perhaps we could share that if that study from last year, if you've forwarded on to us with your permission, with the institute. I read it myself, but if we can get it again, it's quite interesting, because I think one of the questions you could stitch into it this year, because I've seen quite a lot of it, is have you got a dedicated ESG officer on the senior executive team? And we're seeing that kind of narrative begin to emerge now in terms of those job roles. Quite a lot of where sustainability, chief sustainability officer is now moving to the ESG officer role and stuff like that. So I think that'll be interesting just to see, because my sense of it is it's been a huge leap forward. I mean, if you look at the last 36 months, Meghan, in the European context, let's talk about maybe risk in terms of ESG and greenwashing for a moment, and so on, and that kind of sense that your mum kind of brought, because Elon Musk said something. I'm more impressed indeed that she's following Elon Musk on Twitter than kind of than the fact that she's concerned about your future in ESG, which I'm sure is assured. But when we were looking at it there recently in conversation, I mean, Brexit was the #1 threat on the European theatre 36 months ago, as we were heading into kind of January, February, that period before the March closure event of epical proportions. So that was what a lot of people were facing, that whole Brexit issue and the implications of that. And that was a big, big issue, both here in Ireland and the UK, but across the European theatre, and how we get our heads around that. Then the pandemic came on board. Now, ironically, from an ESG point of view, that proved to be a pause moment for the planet, I guess, because carbon emissions were catastrophically reduced during that period when people were staying at home, and clearly, consequently, there was very little road traffic and so on, which brings us on to the huge issue of logistics and the cost to the planet in terms of that whole area. And given the fact that product needs to be brought from China, be it generally kind of on sea, on diesel engines and so on, there's no shortcut around that anytime in the future. So, I mean, what we're looking at now in terms of coming out of a pandemic from an ESG point of view, where there was a kind of I suppose people were pausing and thinking about it very proactively, and there was a behavioral change model imposed on the global population, which was very positive from an ESG point of view, because their consumption had gone down in a lot of particular areas. We're just coming out of it, and the light at the end of the tunnel proverbially is an oncoming train, because we get hit with a war in Europe. And the irony of that, I suppose, is that now, because the price of energy has become materially debilitating to a huge swathe of the population, and from a commercial and corporate point of view as well, from a manufacturing point of view, it's eye-watering what's occurring. I'm not familiar with the cadence in terms of energy bills in the US at the moment, but certainly here in Ireland and in Europe, it's catastrophic what's happening. and a lot of businesses will go to the wall. ESG has gone right down the radar again in terms of where it was up in the top three in terms of conversations and narrative. I suspect it's dropping. It's probably being captured into the price of energy and logistics. So I suppose the question I'm asking you on that is, when you look at it yourself in terms of what next for ESG, you mentioned that we might change the TLA, which I think might be interesting but confusing because we're just getting our heads around ESG, and you just got the saddle on the back of that horse and you're beginning to kind of go from a canter to getting up to a reasonable gallop, and suddenly you run out of road and there's a new kind of rules of engagement. What we're prepping for here kind of subliminally and more kind of granularly is the whole new regulations coming out of Europe, which you referenced earlier, and we might have you back to talk about that again in due course, which will be phenomenal. But what I suppose what we're facing from an ESG point of view now is energy is the number one threat on a risk metrics basis, and how do you kind of deal with that in an ESG perspective in terms of at one hand you've got the situation where you want to be better, but the second issue you've got the rising energy costs and the move. Is it a positive enabler to transition to more sustainable practices from an energy point of view? And then, on the other side, just to throw that kind of other hammer into the ring, you got, farming and the issues there in terms of emissions. And we're not going anywhere soon in terms of aviation and the emissions there. We haven't got electric planes just sorted. Now, I wouldn't want to be the first boy in the back of the plane on an electric one on a transatlantic flight anytime soon. So I suppose where is the next evolution for ESG, Meghan, is what I'm asking you in a roundabout way.
Yeah, I mean, for me, I think it needs to become, we talk about ESG and strategy. I think ESG needs to be embedded in risk management in a very, very deep way. In fact, I'm starting to see some job roles specifically for folks in the risk and compliance space to focus specifically on those areas, because I think until you do that, there could be a lot of distraction on, I don't want to use the phrase like shiny object, but think of what you laid out, how much has changed over the last 18 months with respect to priorities. And so it's all about modeling out what is going to have the biggest impact for your organization, what you need to be paying attention to 5-10 steps ahead.
Yeah.
And that's what's so, I think, been challenging about ESG is what matters to each organization, is incredibly different. I don't think any two organizations might have the same priorities or be impacted in the same way. And so how do we get to this sort of common space and common language to be able to at least look across that in a holistic way?
Yeah, that common lexicon is really one of the issues, because you put up that poster earlier, or that slide earlier, and there was a multifaceted number of different kind of organizations involved, from the UN down to the again TLA City. There's any amount of them, but there isn't a common narrative. I remember kind of maybe about 10 years ago, the Italians were trying to get their heads around white certs, just to have a common kind of issue there, a common cause, so people could monetize their carbon footprint reduction and so forth. And that still hasn't really crystallized in terms of that space, which I think could be very powerful myself. But from a diligent point of view, Meghan, it's and I would have an interest obviously in the corporate governance side and boards and so forth. And I mean, do you see an evolution where, for instance, your products for boards may, for example, have embedded in them kind of software that would capture board carbon footprint reduction, kind of in terms of maybe, if they were off, the ability to offset and stitch it in and be captured and measured within the diligent software suite? I mean, do you see that that's where it's going, the next evolution for boards, as as a material kind of thing that they could report in their annual reports, for example?
Yeah, I definitely think so. I think it's, again, all integrated and interconnected. And that's sort of our vision at Diligent, is sort of bringing this landscape of environmental social governance and also risk and compliance together to be able to do that. And I think it'll be interesting to see over the next most of these regulations going into effect in 2024, be it CSRD or what's happening here in the United States with our regulatory bodies and what they've put forward. I think the next 2 years are going to be really interesting to see, how this sticks, what gets, what talk around enforcement looks like, and how that translates into actual corporate impact, and what companies are actually doing. We spend a lot of time talking about how investors are responding. We're talking about how companies are disclosing the data, but it again all comes down to impact and what companies are actually doing to change to make
Yeah, that's true.
the world a better place, for lack of a term.
No, that's very true, Megan. And you've actually put your finger on it, because it's a carrot and stick effect, really, isn't it? Government will put in kind of metrics in terms of performance requirements and reporting requirements, and they may put in some fines around it. But ultimately, it's the consumer, because it's a corporate world, and the corporates will do what the consumer ultimately wants, because they're there to make money front and center. Make no apologies about it. And I suppose my mind is cast back to kind of events that triggered the CSR agenda to Nike, if you throw your mind back to that, or indeed Volkswagen more recently, and those issues. When you think about it, it's really what the prosumer, if we call them that now, the prosumers, that whole area where you're looking at your labels and the provenance of products really is going to drive. That's going to be the carrot, I suppose, for the corporates, where the stick may be it'll be the stick as well, because if they're not buying their products, they'll go out of business. So I think common sense will drive the agenda maybe a little bit as well, because of material need, because they need to get on board. Because if people are looking at where their products are manufactured and the ethical standards, and we've seen that even over the years with paper, and boxing and so forth. So I'm just interested myself to see the evolution over the next period in terms of that. I mean, we've seen a huge leap forward, for example, on boards, and diversity it's standard now. It's almost the exception to the rule, where that's not part of the tapestry and kind of the conversation. And even within that, that's morphed out to a broader diversity. It's not just about gender now. It's about intellectual. It's about kind of social. It's a broader conversation, which is brings in a broader audience, which is great. So I'm curious to see, as I said at the outset of the question, where the next leap is, because if the last 36 months has shown us or taught us anything, is the future is uncertain and unknown. And when you think you've got a straight line of sight, suddenly there's curveballs coming left, right, and center, if you'll pardon the pun. And I suppose in terms of the software kind of, and the supporting software, and being parochial about it, Megan, again, from a diligent perspective, where do you see the next evolution in terms of the product, where it's going for boards and supporting them in this space?
Yeah, for me, it comes back to our core mission, which is really making sure leaders have the right information at the right time to make, more informed decisions. And so how can we help bubble up that information from, the folks on the street, the folks in the trenches, the operators on a day-to-day basis, making sure that their work gets bubbled up to their managers above them, ultimately in a way that leaders can see and get a holistic view of what's happening across an organization about those risks and opportunities, across more than just the financial performance. I mean, I could spend a whole session talking about sort of the evolution of, I think, the information a board needs to be successful. You think about 20 years ago, and it was, show me how much money we've made this quarter. That dumbs it down a little bit, but I mean, think about, I've worked at Diligent for about 11 years now, and the space has changed so much in that time. ESG wasn't something that we were really talking about 11 years ago. Certainly, really, we're not talking about board diversity, not talking about that impact there. And so when you think about how the aperture of what a board is responsible for, how much that has opened over the last couple of years, with that means making sure that boards are getting the right information to be successful in mitigating those risks and spotting opportunities.
What a lovely kind of way to kind of conclude our conversation. And we could talk about this all day, Megan. It's really been potent. I'm touched by the fact that you've opened up the lens for us in terms of where the future may be, and given us a very, very granular look at what it's about. And it's such an exciting subject. We may impose on your goodwill and have you back again sometime.
Absolutely.
To continue the conversation. I suppose in Irish we have a comment which is Garamila Mahagat, which is thank you very much. We really appreciate that, and may the rose rise to meet you for the rest of the day. We look forward maybe to breaking bread with you, brown bread, if you're over in Ireland sometime, and having a glass of appropriate juice. I'm conscious of the audience. We at this time of the morning, we don't want to be encouraging anyone going overboard too early. As I say, look, Gurmila Maga, thank you for your time. Really appreciate you getting up, and it's not easy. I know it's a very early morning there. So on behalf of everyone here, and indeed the Institute in general, we appreciate your time, and indeed we particularly appreciate diligent support in this masterclass series, which you've taken it out. You've put the bar very high for those that follow you. I almost feel sorry for them. So as I say, enjoy the rest of your day. Have a well-deserved coffee and a breakfast, Meghan, and we look forward to people joining us at the next session, which is coming up in a couple of weeks' time. So look, we'll have you out in time. It's 11:25 here in Ireland. Meghan's going to have her coffee and catch her breath, and we look forward to talking to you again. Slán go fóill, which in Irish is all the best, Meghan.
Thank you so much.
Bye, everybody.
Yeah.